All right, good morning. Today is September 11th, 2024, and I am back with another edition of the Wednesday live show. And this morning the CPI numbers came out, and depending on who you listen to or read, they were hotter than expected or in line, right? But thing of it is, the core CPI was at 3.2, and so all of a sudden today, the debate up until now has been whether the Fed is going to cut 25 basis points or 50 basis points. And so with today's numbers, it looks like the market is adjusting to a 25 point basis rate cut next week. So the Fed meeting's next week, and they're about to embark on a rate cutting cycle, which is going to be quite interesting because it's the end of a rate hiking cycle. And so the big question is going to be whether what the market does, because quite frankly, and I've been saying this on this show for a long time, the market has actually been rallying for about 2 years based on the idea that the Fed is going to cut rates, right? I mean, it's literally been a couple of years since, there was the talk of the pivot, and you remember that. I mean, it's just incessantly talked about a Fed pivot, Quite frankly, they were talking, on CNBC and a lot of talking heads about a Fed pivot while they were still raising rates, right? And so I'm starting to think that the market itself has been rallying all this time in anticipation of the Fed pivot. And so, which basically they're going to, I'm sure, I'm sure, beginning in next week's meeting, they're going to cut rates. And now all of a sudden, yeah, the narrative is, I've always kind of made fun of the conventional wisdom narrative of the time, but the narrative has sort of shifted to the Fed's gonna, cut by 50 basis points based on the job numbers that came out recently, and the fact that it's becoming kind of apparent that the economy itself is slowing. So people are saying they're behind the curve. But anyway, so they've really painted themselves in a corner, and we've talked about this before. Because worst case scenario is they start cutting rates and inflation picks up steam, right? And so, I mean, it's just quite honestly to me, the Fed has made a series of, and this has been going on for a long time, just a series of monetary policy, just bad decisions. They always seem to be behind the curve to some degree, and and quite frankly, it's a lot of a lot of the fact that we're paying higher prices for everything is directly attributable to the fact that they created trillions of dollars out of thin air, which you know has had to be I mean, it had to be intentional. It was intentional, based on the idea that anybody that knows anything about history knows that inflation is the direct result of governments creating money out of thin air. So anyway, besides that conversation, I don't want to get too far deep into the woods, but today is CPI day, and the market's having a negative reaction because I suppose that the narrative was is that they were going to potentially cut 50 basis points. Now they're only going to cut 25 basis points. But my original lead into this conversation was the fact that maybe it was priced in, and so when they do actually cut rates, then the market may, I mean, in the past, and you've seen these charts before, in the past, when the Fed starts cutting rates, a lot of times the market reverses, right? Especially after the type of run up that we've seen. So, so anyway, what I meant to do here was draw what some are perceiving as a big double top, right? There's the double top in the market. I started off by drawing sort of I don't, you can call this a support and resistance level, right? And you could, because here's the thing, back over here in late June, you can see how the market consolidated in this sort of sideways range, and then in July broke out, took another leg up, right? So that was actually a big resistance level here, and of course this was all-time highs in the history of the world. So market broke out, took a leg up, and it was kind of short-lived, a couple weeks there, and then right back, bounced right off that support level there, and then this is when actually, this was sort of whenever you see these big red candles, and this week I decided to do things a little bit different and look at candlesticks. So, because typically I like open, high, low, close bars, but that's a different story. Anyway, there's some warning flags. Whenever I see a big red candle, or a long range bar, as I call it, down bar, that's like it's a raises a caution flag. And so sometimes you get those, and we see this a lot, right? Like just here recently, a few days ago, we got that big sell off, big down red bar, and then we bounce a little bit, right? And so even down here, this what I was pointing out here in July, we got a couple of big red long range candles down, and then we bounced a little bit, and then boy, that gap down here, that gap and that follow through on the downside. And then of course, you bounce a little bit because there's always going to be dip buyers. See, that's the thing. There's there's stock buybacks. There's people that contribute to their 401ks and all that good stuff. And so, I mean, there's always some sort of a bid under the market. And what I believe happens is that active managers, they wait for these dips and then they deploy capital that has built up, and that causes like sort of a buy the dip mentality. Anytime the market pulls back a little bit, there's always some dip buyers, and especially, especially we're getting to the time of year where people are going to start chasing performance, and so that's going to be interesting to watch, right? When you get into the performance chasing, because I saw a statistic, and it's probably been like a year ago, maybe 2 years ago. I saw a statistic on CNBC that cracked me up. It was something to the effect of like, you know, 85% of active money managers underperform the indexes, and then the very next thing they do is bring on some active manager to tell you what stocks to buy, right? And I mean, that's CNBC's whole, that's their whole game there is they get all these people on here and, to basically just talk in their book. It's so blatant at times, and as I've mentioned recently, I no longer have the sound on CNBC, but every now and then they have somebody on there that I know or I respect, or something like that, or something interesting like right now they're giving the White House spin on the CPI data, and so if I wasn't doing the show, I would probably listen to that, even though I don't need to have the sound on to know what to expect. They're going to spin the CPI data. Yeah, so I read Zero Hedge today because they always dig into the CPI numbers, and interestingly enough, its services CPI is running hot, which makes sense, and goods CPI is cooling off. It's actually coming down, which brings me to something else here. I don't want to get too far off a topic here, but I mean it is CPI day, and so let me just save my levels there. I wanted to look at oil because oil is a huge driver of inflation, as we all know, right? And so when the price of gas is high, then that drives the price of everything else higher. I won't say everything else, but because back in the old days, much more of the economy was based on tangible items that moved by truck. So, fortunately, nowadays it's not the case, but At the same time, the price of oil is extremely important when it comes to CPI. This is amazing, right? And quite frankly, it's counterintuitive. It's very counterintuitive to see oil down here at 65 bucks a barrel, with all this turmoil in the Middle East. And look at this level here. Look at this sort of zone here, call it, between say 60 and 65. I mean, we're going back to, with oil, there's always like a little, there's basically a zone especially when you're looking at it longer term. And so this is an amazing chart. And hey, I'm surprised that there's not more talk about the Strategic Petroleum Reserve, because the Strategic Petroleum Reserve, and I don't profess to be any sort of expert on oil, and so I'm basically just mentioning all this because today's CPI day. And of course, I've been watching, there's a gas station at the corner. When I leave my neighborhood, in order to be able to pull out and look both ways for oncoming cars, I get to see a sign that tells me what the price of gas is. And I've noticed just recently here how it's come down. It's like 329 or something last time I looked, something like that. But and by the way, I live like kind of in a touristy area. The price of gas here is either typically my corner is typically 10 cents more than it is a mile away, which is kind of interesting. But I know better than to buy gas at my gas station, because you can drive anywhere else and it's 10 cents cheaper, sometimes 20 cents. But I digress. The oil at 65 bucks a barrel seems like a pretty good deal to me, right? And so if I was in charge of anything, well, put it this way, it makes sense to re, you know, buy some for the Strategic Petroleum Reserve at these prices, because um, while the price of everything else, right? And so you look back here, this was the COVID, or I should say the pandemic freak out sell off, right? Where the demand for oil dropped off a cliff. I can't remember if this is when the oil contract actually went negative. I can't remember if that happened there, or, because I don't follow. I mean, I just kind of follow oil here and there. That's another reason, people joke about watching CNBC or whatever. But the thing of it is that there's a lot of things that I don't really follow closely. I still have a pretty good idea of the prices and what they're trading for and what's going on just by having the stupid ticker on, which, and I've talked about how they basically ruined the ticker. This last CNBC updated their ticker, ruined it. So I should probably switch to Bloomberg, but Bloomberg's too much of a, it's too noisy too. So anyway, um, oh, they're talking to Lyle Brainerd. Huh. I just, excuse me. Um, so here you go. Price of oil being low like this is going to have a positive effect on the CPI number. So that's good news, right? It's good news because the fact that we're paying, 25% more for everything else, it's nice to not be paying, it's nice that gas is not, $4 or $5. That's nice, but at the same time, you know, people that pay attention to geopolitics and all this and that would argue that it's kind of counterintuitive, which is typical in the market, something being counterintuitive, um, oil being so low. But then again, election coming up, this could be some sort of uh, a ploy to make things look better. So anyway, so let's see here. Oh, CPI day. CPI day. So back to my charts here. I wanted to look at and as you can see, I got a bunch of different configurations here of all kinds of stuff. I've pared my watch list down almost nothing because these charts were, for whatever reason, these charts were just slow. They were acting really slow for me, and so I decided that, I would just kind of pare my watch list down to nothing and type in ticker symbols and see if that made a difference. And it's hard to know, to be honest with you. It's hard to know. See, the response time on these charts, and trust me, it's not my internet connection, it's not my computer, it's just the response time on these charts I feel as though is not up to par. So, but it is what it is. Anyway, so here's the NASDAQ 100. Interesting thing about the NASDAQ 100, it's not quite looking as healthy as the S&P. For one thing, that double top here is certainly not a double top on the on the NASDAQ, right? I mean, it's the NASDAQ's like, big run up, peaked out, big sell off to this is 200-day moving average. So I like to keep my charts simple, 50-day, 200-day, and as you know, those are, marginally useful, but I guess since everybody else is using them, it's still nice to have them on the chart. So there you go. I mean, there's a big overhead resistance line on the Qs, and quite frankly, that 50-day moving average, I mean, look at this. It was resistance, that's exactly where this latest, sort of sell down started from. When you start to see a series, typically now, I mean, you see some big red down candles here, and then we kind of got on this, there was basically sort of a V reversal and then a huge run up, the AI hype run up, I guess you could call it. But this time around, it's in a little bit of a precarious spot right here. You can also see, I like to keep things simple, right? Relatively simple. You can see that just last week, it basically bounced off, a significant support level, right? This was resistance, turns into support, and and then there's of course pokes above and below it. But anyway, this is not the greatest looking chart, right? And the fact that we're seeing long range red bars, I mean, we're getting a pretty significant sell off here. The funny thing is that this morning when the CPI numbers came out, I mean, prior to that, the futures were higher, and then they sold off, and then they actually, I believe, the market gapped up. Let's look at SPY here. Yeah, this morning there was a little bit of, and see, this is part of the reason why I prefer the open, high, low, close charts. Like, let me just go to this chart right here real quick. It makes it just a little bit easier for me to see the open here. So, yeah, actually by the time the futures actually opened this morning, they were right about where the close was yesterday. But oh boy, look at these big long range down days. And so the thing of it is, the sentiment these days turns on a dime, right? And so Friday we had that big sell-off day, which was kind of a mirror image of, a few days before that. But then you got these dip buyers, right? So like Monday morning we get a gap up, and then the past couple of days the dip buyers were feeling pretty good about it. And then of course, CPI comes along today, and like I said, everyone's worried about yet another policy mistake, but the Fed has already said, they've basically come out and said that they're going to cut rates in September, right? It's sort of priced in, but the thing of it is that, and I'm probably not telling you something you already don't know, but in the past, when the Fed embarks on a rate cutting cycle, typically that means they're doing that because the economy is slowing down, and or we're heading into a recession, or we're already in a recession, or whatever, and so the market tends to sell off. And so, there's a couple different trains of thought here, a couple different narratives. One is that the market has been running up all this time in anticipation of the rate cuts, and then, buy the rumor, sell the news. So, so you can basically go all the way back to, you can go, I think, you might be able to go back to either 2 years ago, or definitely 1 year ago, and you could argue that this run up is based on a couple of things. I don't know why it's saying that this chart's not saved, but yeah, it looks pretty good, so I'm going to save it. um, oh, I guess because I drew this on it and hadn't saved it yet. That's what it was. I drew this horizontal level here. I don't really need to draw the double top on this chart. This is a weekly chart of the S&P, and it's pretty obvious what we're looking at here. So, I mean, is there such thing as a double top? Yes, because you have to think that especially when the market's at an all-time high. See, that's the other thing that you can refer to your technical analysis books for. But my thinking is that double tops are legitimate when the market's at an all-time high. Actually, more legitimate than when the market's not at an all-time high. For instance, somewhere back over here, when the market was below the highs, double top doesn't seem like it would carry as much weight. I don't know if it's even a legitimate pattern. Of course, obviously at each level there's levels of support and levels of resistance, and there's psychology of the participants behind that. But at the all-time highs like this, there's definitely some significance to the idea. And of course, we talked about this last week. We're just in like a seasonal sort of pattern here, and September's seasonally weak, and everybody expected it to be weak. And so, hey, no big deal. Let the market sell off in September, and then come back, and out of the blue, we'll rally back up and break out of this top, and everything will be great. See, the stock market's job is to keep up with inflation, in theory, over longer periods of time. And so, the purchasing power of the Federal Reserve note has been declining since it became a Federal Reserve note. And so, the stock market is how you preserve purchasing power. And there's times where every point in time means something. And so, you can pick arbitrary points in time and say, oh, wow, I've got way more gains than I lost in purchasing power. And then there's other times where, the market sold off or whatever, and so inflation killed you. But the thing about inflation, and the reason I keep coming back to this, because it's CPI day, and you guys know that over the years, inflation's sort of been my number one thing. But the Fed's really in a pickle here because they've basically committed to cutting interest rates, and they sort of have to. I mean, there's a laundry list of reasons why the Fed has to cut rates. The main one being the national debt and the interest that's being paid on the national debt, but that's a whole nother conversation. So, interesting to see this weekly, right? Like, look at last week and look at where we are now, and it's not really, and today, of course, is kind of what everybody was waiting for. There's numbers coming out tomorrow too that are going to affect this. But so the headline inflation numbers basically came in line as expected. But then I also saw, core CPI hotter than expected, even though it looked like the consensus number to me. So I'm not sure what to make of it. But anyway, I know that certain things like people were complaining about their car insurance, like car insurance rates have gone up. I saw something recently where homeowners insurance in California is expected to rise like 40%. So the thing about inflation is that it's cumulative, and I say this all the time. If the inflation rate was 0%, everything will still be way more expensive than it was a few years ago. And that's the real kicker there is the general price level that we're paying for just about everything is up, roughly 20, 25%, and you could argue, even more than that depending on what it is, but the price of everything went up over a very short amount of time, honestly, since the pandemic, and it's the direct result of, let me zoom this back. It's always instructive, at least for me, um, to have the pandemic sell off on the chart because as you recall the market dropped roughly 35% in a matter of weeks, right? And so that adds some perspective because that was a huge change in everything on the timeline of history. That was a major shock because of the fact, besides the fact the market dropped 35% in a short amount of time, but the reaction to that was the Fed creating, X trillion dollars out of thin air, watering down the money supply, which they had to have known, obviously, that was going to result in inflation, and sure enough it did, just like it has, all throughout the history of money in the world. Right? I mean, you can go back to the ancient Romans, right? And every other monetary system since then, there's like there's a rule is when you create additional money supply, eventually it results in inflation. And so the Fed even admitted, it didn't make NBC nightly news, obviously, but like a year ago or something, the Fed admitted that they overreacted to the pandemic. So, but that's besides the point, And then of course there's government spending, which I suppose you can't lay 100% blame on the Fed because, anyway, I don't want to get off on a tangent here, and I've used up just about as much time talking about macros. I always do that. I want to look at a couple of charts real quick. That was my idea. I was going to start a new thing here on the show and like bring in a few decent sort of trade ideas to the show, right? I think last week I liked Tesla. I was looking at Microsoft. The weekly chart looks like a big sort of head and shoulders top, right? But the daily chart kind of looks like that too. But it's just got an interesting pattern, right? I mean, you got kind of a little bull flag right here. Hang on a sec. There we go. Yeah, whoop, you got bull flag happening right here. You've got I need to get a little bit better with these charts, and I've only been using them now for a couple of years, but you got sort of like a big area of like support and resistance, and that's not really what I would consider to be the neckline, or is it the neckline? If this is a head and shoulders, I don't know. But anyway, I'm not a huge proponent of head and shoulders patterns, but anyway, I mean, you kind of get the idea here. So Microsoft's got an interesting pattern. If it were to break out of this little flag, obviously it's going to run into some resistance right here, major resistance, but it'll look pretty interesting. If it were to rally up to here, and there's actually a pretty big zone of resistance right there, but this is one to keep an eye on. Some of the other ones, so I wanted to look at Tesla real quick because last week, and this is crazy because when I was on the show last week, right, I drew this trend line. I drew this, same sort of pattern right there on Tesla, like right there. And we were doing the show, and I was like, and so it had that huge pop. But look at that. Um, that just goes to show you. I mean, you can be right in the short term, and whether it's just amazing to me that you had that really nice 2 day pop, and then in one day it retraced the whole thing, and now it's still a little bit higher. So I mean it was a legitimate idea, and how one might have played it. There's so many of these Mag 7, or I don't know if you can. This is a Mag 7 stock, but I want to look at another one too. I noticed that where is my here we go. I wanted this because to look at ARM because well, the semiconductors, I don't want to take the time and go through all the semiconductors here, but I did notice that ARM, which is, a recent IPO, and it's got a 200-day moving average, right? The 200-day moving average is forming, and there's like a perfect pivot low, just last week, pull back and a perfect like pivot low to the 200-day moving average. So then you got the MACD sort of coming up or whatever, but anyway, it's an interesting chart to look at, and obviously we can't talk about the market without looking at Nvidia. And the most it used to be Apple was the most widely followed stock in the market, and obviously it still is. And of course they had their big. I haven't read a whole lot. I haven't had the time yet. Yesterday I wasn't really paying attention to what Apple was coming out with as far as their iPhone 16. Their phone business is basically is the main business, and so well, and here I'm looking at Nvidia and talking about Apple, but I think I mentioned this last week. The thing about Nvidia is that it's another controversial stock. This is one that every single money manager and portfolio manager is obligated to own this stock, because if they don't, and of course, they probably already all do own it, but it's going to be interesting to see what happens here because you got a significant dip and a consolidation here right in this area, and so quite frankly, it's a relatively low risk, high reward zone that it's in right now, just simply due to the fact, and quite I wish I could tell you exactly what it's going to do from here, but everything's all about odds and tolerances and all that kind of stuff. But I can tell you this, you know, before they did their 10 for 1 split, you'd be looking at, I mean, so it was a $1,400 stock, and then it was, $1,000 stock, and now it's, $1,100. So, but anyway, so the fact that they did the split kind of makes it a little bit more accessible, I should say. Oh, here's what I wanted to do. I wanted to take this support level all the way back here. So you got a couple things going on. Somewhere in the range of 100 to 110, somewhere in this zone is, theoretically, it's a decent accumulation zone based on the idea that there's probably a ton of psychological support right at 100. And so this is going to be, when the market settles out, when the money starts flowing back in, this is one of the top stocks it's going to flow back into. So one of two things are going to happen. Like the market's going to tank and take everything with it, and this thing's going to come down here and, test the 200-day moving average. But it's basically come off a lot. It's catched a little bit of bounce, and so somewhere in this area, and there's so many ways. I look at this thing, and there's a lot of ways to play it, but I'm just basically looking at zones here. So there's tons of support in this area here, and you could even take that up to, yeah, call it 100. I mean, this is sort of an outlier candle right here, especially the fact that, it gapped down here and then rallied. Look at that rally. So you can see the symmetry on this chart. See, that's kind of the nice thing about it, is you can sort of see the symmetry. I might have to save this. Oh geez, these stupid things. I swear I'm thinking about switching to TC2000. That's right. The thing of it is, I hate the, on my other computer, I've got, the charts that I use from my trading platforms, and so I hate to pay for charts when I got more charts than I need already. And back in the old days, I used free stock charts, which was part of TC2000, and then they did away with those, and so now I'm stuck with good old stock charts, ACP. Look at the MACD here. If this gets a little traction going to the upside, so it may come back in and consolidate a little bit more, but this is, we'll put it this way, below 100, between 100 and 110 is, unless this thing falls apart, and if it does, then look out. you know. Um, real quick, I wanted to look at Google because they got some antitrust thing happening here, and I reserve the right to call Alphabet Google forever, right? Yeah, this is looking pretty nasty here. I mean, obviously it's way oversold in that, but boy, that's a rough looking chart there, right? It is it is like right around some pretty major support. It's actually poking through. So, 150 bucks is the over under here on this. That's a nasty chart. Once you get these peaks in the sell downs like this, I mean, sure, it could bounce or whatever, but this is a weekly chart, and so, Google's in a downtrend, and quite frankly, a lot of these Mag 7 stocks, people are obviously rotating to other sectors, and so these stocks are looking pretty rough. Um, anyway, real quick, one last peek at SPY, just because today is a negative reaction to the CPI numbers that just came out, and so it bears watching, right? Bears watching. So this is we're back on the daily chart here. Yeah, it looks to me like this sell-off could go a bit deeper. And then of course, everything's going to be kind of in limbo until the Fed announcement next week. And so in between now and then, everything's just conjecture, and I advise you not to watch CNBC because it's going to be a constant parade of, is the Fed going to cut 25 or 50 basis points? And quite frankly, everyone's got an opinion on that. So anyway, thanks for tuning in. I'll see you back here next week, same time, same place.